Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage and protect your wealth. Don't forget to subscribe and like these videos. Well folks, we just finished the worst quarter in 137 years in the Dow Jones, and the S&P 500 finished down exactly 20% year to date. This has been a disaster to say the least, especially if we look back. We can easily see the highs that were just 7 weeks ago. All of this came out of nowhere with the virus, and in my opinion, a lot of very bad mistakes made by the administration to shut down the economy. I'm not saying that we shouldn't have had a medical response, but I am saying to shut the economy down is a huge mistake. There's so many things that are broken that will take years to rebuild. I talked about this equity decline. What it really did was it took the veil off of what is really the issue, which is debt. We watched the 2008 and 2009 crisis get bailed out by debt. Market participants have made the exact same mistakes again by expanding debt, using derivatives, which to attempt to mitigate risk, because they think they figured it out from last time, but they now have exposed us at greater levels than ever before. This report is for Wednesday, April 1st, which is the beginning of the new quarter, but it's also the beginning of the crisis. Everything we've seen so far has been talked about. People have lost their jobs. Income's been disrupted, but this is where the rubber meets the road. This is where people aren't going to make their rent payments. They're not going to be able to pay their bills. They've been laid off. They're going to hoard cash, even more so than they did toilet paper. And what's going to happen is there's going to be a capital dislocation. I've talked about this over the last several weeks. This disruption is going to be bigger than it ever has been before in the history of civilization. These events will not be easy to recover from, and the potential for a complete collapse of the debt is imminent. I believe his name is Gunlack. He's a big bond guy. He's talking about equity markets. You know, I don't care what he thinks about equity markets. Talk about your market. Talk what you know. This is a scary thing when people are trying to divert, especially a bond guy with a bond fund, divert attention away from bonds. It's all about bonds. It's going to be all about MBSs. We're going to see the same thing that happened before. The counterparty risk is going to be absolutely huge. There's no way to escape it. And this time, I've talked about this before, in previous crises, there's always been a different sector or different player that's affected. I believe it will be primarily the insurance folks. I've warned before that this could disrupt everything, including annuities and a lot of other elements. And people have been selling these products for years based on a guarantee, and I still think there is a tremendous amount of risk in those instruments. Investing public is very naive about the risks that they were taking on. But as we go forward, more of this debt is going to come into play, especially since no one's going to be paying their rent. Probably 30 to 40% of the people out there will not be paying their rent. This is going to disrupt the entire multifamily housing. There's going to be all types of ripples through the system because of this. Fannie and Freddie have already shut down their mortgage operations. There are all types of folks that were offering mortgages that are canceling mortgages that were already agreed to be funded. They've just canceled them. There's clauses in all of these contracts that they can cancel them at any point for any reason. So all of these things are happening because everything will begin on April 1st, and by May 5th, we're going to have a full understanding of what the impact of this disruption of capital is going to be. Many have asked, what do you think about the Fed? Are they willing to bail this out? The chances are yes. They have no choice. They've already made these big bets already that we've seen. They've taken the reserve requirements off the banking system So there's basically no money behind anything anymore, and it's just going to be the Fed supporting things. And I talked about the unintended consequences of having involuntary socialism. The administration is talking about making equity investments in the airlines, many other industries. And as I discussed in the past, this is going to make for multiple years for the government to get out of these businesses. It's very likely that some of these cases, they will never get out, depending on how these transactions work. So remember, when we saw the equity decline, it took the veil off the real issue, which is debt. This is going to be catastrophic. Even if the Fed bails us out, there's going to be inflationary scenarios. Market participants will begin to look at that. The bond vigilantes are going to be looking at that. And if we start to see rates to increase over the next 6 to 8 weeks, we're going to know that these issues are real. So everything I'm talking about is a disaster. I want to put one little hedge out there. The hedge is that depending on what's done, how it's perceived, and what type of actions we see from market participants will determine the ultimate outcome. I don't claim to have any crystal ball, but right now the risk levels have never been higher. I've talked about this a lot. Our customers are for the most part in cash. If you watched the video I did for Monday, and I told you about the aggressive model that went long, that was on a very small sleeve of equity investment. It wasn't for all the money to go back in the market. And that signal is actually becoming somewhat vulnerable, and I'll talk about that in the technical section of the show. Conclusion, the things that we are going to see as we go through the next quarter, the first quarter was the disaster. The second quarter is going to be the reality of what's going to happen. You're going to see unemployment levels reach above 10%, maybe 15%. People are talking about a potential 35%. We've got claims coming out on Thursday. They could increase another 2, 3, 4 million this week, just like they did last week. These are catastrophic situations that are happening. So continue to be very safe, remain in cash, but going forward, you have to be very cautious. I don't think any major decisions can be made about getting back in the market, looking for value just yet. I talked about this before, but I still think there's another leg down after this consolidation, at least 8 to 12 weeks, and we go down again. We could see the S&P 500 reaching the 1600 level during this next leg down. So buckle up, get ready for a lot of risk ahead. Watch the bond markets, watch the mortgage markets, and watch the insurance companies. Those are going to be the players that are going to be at the most risk. Let's take a look at the technicals to see what clues we can get for the next several days. As we look at the daily S&P 500 chart, I discussed yesterday, I thought we would begin a minor correction. You'll see all the PPMs are rolling over. We saw a reversal off of the 21 period moving average. It went slightly above it. In fact, it went to a number that I talked about 2 days ago at 2640. The intraday high was 2641.39. We closed lower on the session. We're following through overnight at the moment, down nearly 3% as the S&P has penetrated through the 2500 level. As I discussed on Monday's show, the range expectation is 2460 to 2640. So we hit 2640. We now should move down toward the 2465 level. And if it doesn't hold, we'll suggest a filling of the gap down at the 2344 level. My expectations are for the S&P to continue to consolidate. I've been talking about somewhere between a 8 and 12 week consolidation that's still in play. There is a 40% probability that the market could go straight to new lows. The intermediate charts show that we went 2 times up to the 200-week moving average. We bounced off of it twice. I talked about this being a resistance point. That's exactly where the market has stalled The pattern suggests and confirms that a move to the 2460, 2450 level is highly likely. One of the elements on the weekly chart is there is an attempt, the PPMs, to make a turnaround. They're starting to see some dissipation of the downward risk. One of the things I talked about yesterday that I was encouraged about was the drop in the daily volume. Well, that is over. We were up 31.06%. We were at 7.4 billion shares. That is not a good sign. Meanwhile, we have seen a continuation of the contraction very slightly of the daily ranges, but not enough to make a difference. So this also confirms the likelihood of some lower prices for the next day or two. 2 days ago, I discussed that the gold market was likely to go back to 1600. Yesterday and overnight, it's continued to dip, but it should hover now between the 1590 and 1630 levels over the next couple sessions. Momentum is trying to turn up a little bit here, but there's not enough there to signal any kind of sustainable move. We'll continue to trade in this sideways range. The intermediate chart on gold confirms this. The 10-week moving average is right at 1600, and that looks to be the point where this stability will start to set in. I don't expect to see any directional moves for a number of weeks yet. This will conclude the broadcast. We'll talk to you tomorrow night.